A single law change in 2026 just made millions of people's so-called hidden digital assets fully discoverable by the government, and the wealthy already moved theirs. We're not talking about offshore bank accounts or shell companies. We're talking about crypto wallets, NFTs, digital tokens, assets that most people assumed existed in a legal gray zone. That gray zone is closing fast. And the people who built serious wealth inside it are restructuring right now before the window shuts. Here's what's actually happening. The Infrastructure Investment and Jobs Act, signed back in 2021, buried a provision that most people scrolled right past. It redefined the word broker to include anyone who facilitates digital asset transfers. That definition kicks into full force in 2026. And when it does, crypto exchanges, DeFi platforms, and even certain wallet providers will be legally required to report your transactions directly to the IRS, just like your bank does. This is what insiders are calling Disclosure Day. The moment the digital asset world gets plugged into the same financial surveillance infrastructure as everything else. But that's not even the strangest part. The reporting rules don't just cover simple buy and sell trades. They potentially capture NFT sales, DeFi yield activity, and peer-to-peer transfers above certain thresholds. For the average person with a few $100s in Bitcoin, this probably feels distant. But for ultra-high net worth individuals holding 7 or 8 figures in digital assets, this is an existential restructuring event. So what are they actually doing? First, many are moving assets into legal structures, trusts, LLCs, family limited partnerships, that create a layer between the individual and the reportable asset. Second, some are relocating their legal domicile. Countries like Portugal, the UAE, and the Cayman Islands have either zero capital gains tax on crypto or no mandatory disclosure frameworks tied to U.S.-style reporting. Third, and this one surprises people, a significant number are converting volatile digital assets into tokenized real-world assets. Think tokenized real estate, tokenized private equity, structured instruments that sit in a different regulatory category entirely. None of this is illegal. Let me be clear about that. Tax planning and asset restructuring before a law changes is entirely standard practice. The wealthy have always done this. The difference is, most people don't hear about it until after the deadline passes. And here's why that gap matters for you, specifically. The 2026 rules will also introduce cost basis tracking requirements. That means if you bought crypto at different prices across different wallets and platforms, you now need clean records, or you could be taxed on gains you never actually made. If your records are messy, the IRS defaults to the least favorable calculation. That's not a technicality. That's real money leaving your pocket. There's also a provision being debated around the $10,000 reporting threshold, the same rule that applies to cash transactions. If it passes in its current form, certain crypto transfers above that level trigger automatic disclosure, regardless of whether you owe any tax. The broader picture here is this. Digital assets are being pulled into the formal financial system, whether the crypto community wants it or not. The era of plausible deniability is ending. The wealthy understand this. They don't fight the system. They reorganize around it, early, with good advisors, and with options that most people don't know exist until it's too late. What you can do right now, consolidate your wallets, document your cost basis, and if you hold significant digital assets, talk to a tax professional who actually specializes in this space before December 2025. The game isn't rigged against you, but the rules are changing, and the people who move first always pay less. If this opened your eyes, subscribe, and tell me in the comments, are you restructuring your digital assets before 2026 or waiting to see what happens?